Okay, let me ask you this. What if I told you there's this global food giant, a real powerhouse trading on the New York Stock Exchange that, well, our analysis suggests could be significantly undervalued. But here's the catch, right? This company comes with a past, a history so controversial it honestly keeps a lot of seasoned investors up at night. Today, we're diving deep into JBS NV. It's the world's largest meat packer.
That's exactly right. And despite its current share price, which is hovering around $13.80, our own educational analysis points towards an intrinsic value potentially somewhere between $18 and $24 per share. So that immediately sets up the core tension for today, doesn't it? A potentially undervalued situation, but it's absolutely coupled with some pretty significant complex risks.
Yeah, and that's really our mission here in this deep dive. We're taking all your sources, every article, every bit of research, and we're distilling it all. We'll look at JBS's huge business, its unique management, the financials, market perception, who owns it, and all those inherent risks. The goal is really to give you a quick but well-rounded picture of this, while fascinating and sometimes pretty confusing company.
And speaking of watching closely, Wall Street definitely is. There's this kind of cautious optimism about their upcoming Q2 2025 earnings. They're due out August 13th, 2025. Analysts are kind of forecasting an EPS, earnings per share, around $0.28.
Yeah.
And revenue, expected near $21.36 billion.
And this isn't just, another quarterly report. It feels like a critical test. A test of JBS's resilience, especially with all these broader economic worries floating around, like the potential for new tariffs maybe looming. So for those of you really following this stock, definitely stay tuned. We promise we'll cover these earnings practically within minutes of them being released. All right, let's try and unpack this complex beast. We'll start by laying some groundwork. Chapter 1, Business Understanding.
Okay, so when we talk JBS NV, we're looking at the parent company. It's actually domiciled in the Netherlands, and it recently got this dual listing, not just on Brazil's B3 exchange, but importantly, now on the New York Stock Exchange too, ticker's JBS. It's important to clarify, right? Your original query might have zeroed in on JBS USA, but our analysis, it covers the whole consolidated global entity. That gives us the complete view.
That distinction feels really key, doesn't it? Because fundamentally, JBS is just this massive, globally spread out platform. It prepares, packages, delivers a huge range of protein products. We're talking a network serving over 330,000 clients. In more than 190 countries, it's kind of staggering. And what's really interesting is how their revenue breaks down geographically. About 74%, maybe a bit more, comes from domestic sales within the countries they operate in. The rest, around 26%, is exports. How does that diversification actually help them, especially when you think about risks like, say, tariffs?
Oh, it's absolutely fundamental to their strength. This internal geographic spread, it acts as a really powerful hedge against those geopolitical risks. So, for instance, if the U.S. slapped tariffs on Brazilian beef imports, well, JBS's North American operations, they'd be largely insulated. Why? Because they produce and sell inside the U.S. Those domestic sales are naturally shielded. It really shows a kind of strategic resilience baked into their structure.
Right, and you can see that global footprint in their main operating segments. You've got the core Brazil segment, mostly beef. Then Saguara, which is more value-added chicken and pork, also in Brazil. Then you have dedicated segments for Beef North America, Pork USA, Pilgrim's Pride for poultry globally, and a big presence down in Australia, too, covering beef, lamb, pork. It really is a worldwide operation.
It truly is. And their product mix, it goes way beyond just basic fresh or frozen meat. They've made a really smart strategic shift into higher margin stuff. Value-added products, think pre-cooked meats, hamburgers, sausages, deli items. These usually offer better profitability. What's also quite notable is their investment in the future, right? Alternative proteins. They own Vivera, a big European plant-based brand, and Biotech Foods, which is working on cultivated protein tech. And all this sits under a huge umbrella of over 70 brands. Names you'd probably recognize like Swift, Pilgrim's Pride, Freeboy.
It's almost difficult to wrap your head around the sheer scale here. JBS isn't just big. It's literally the world's #1 producer of beef and poultry, and #2 globally in pork. They run over 600 facilities across the globe, employ more than 270,000 people. I mean, wow. So when you consider all that, their main value proposition for their customers becomes pretty clear, doesn't it? They're this unmatched, reliable, large-scale source for diverse, high-quality, and crucially affordable protein. They offer consistency, food safety, things big clients really need.
Exactly. And at immense scale, it helps them navigate the wider industry trends much better. For example, right now, the U.S. cattle market. Inventories are tightening up. Most economists expect that to push beef prices higher in 2025. Now, for a company like JBS with its huge cattle operations, that could actually translate into better revenues, maybe better margins.
And then there's inflation, which just keeps sticking around. Overall food price inflation might be, what, around 3% year over year? But beef and veal prices, they've jumped way more, like 10.6%. So that hits their costs, but also affects their pricing power. Plus, consumer tastes are always shifting. There's growing demand for meats with specific claims, organic, grass-fed, whatever. But at the same time, you see people trading down, maybe choosing more chicken or pork because budgets are tight. JBS, with its diverse portfolio, seems pretty well positioned to catch consumers at both ends of that spectrum, right? And of course, they're pushing hard on tech automation in plants using AI for optimizing supply chains.
Definitely. Now, in terms of who they're up against, the competition is fierce. You've got giants like Tyson, Hormel, Smithfield, Cargill. It's a tough crowd. And it's a super regulated space. New U.S. food labeling rules are coming in, plus all the evolving ESG regulations, SEC climate disclosures, the EU's deforestation regulation. It certainly adds complexity.
Yeah, despite all that competition and regulatory heat, it sounds like JBS has built a pretty significant economic moat. Can you explain what that really means? And, how does JBS actually manage to have one?
Yeah, good question. An economic moat, basically, it's a durable competitive advantage, something that protects a company's long-term profits and market share from competitors trying to muscle in. For JBS, their moat isn't just one thing. It's got several layers. First, you got brand strength. Those 70-plus brands, many are well-established. They create customer loyalty. Second, and maybe this is the biggest one, is their unparalleled cost advantages. Just from their sheer size, this gives them massive negotiating power with suppliers and allows them to run super efficient, optimized plants. Third, you could argue there are moderate network effects. For their really good clients, switching to another supplier who can handle that volume and diversity, it's costly, it's disruptive. And finally, that unique, globally diversified production platform. It gives them operational resilience that few others can replicate. They can shift production or sales based on market conditions or shocks. You put all those together, it creates a really strong barrier for competitors and a solid competitive edge.
That really does paint the picture of a formidable player. Okay, let's switch gears now and talk about the people making the decisions. We're moving into Chapter 2, Management Evaluation.
Okay, so at the very top, the global CEO is Gilberto Tomazoni. He's generally well respected in the industry, actually got named Best CEO by Institutional Investor back in 2023, seems to have a strong operational background.
Right.
Yeah.
But we just can't talk about JBS management without immediately addressing, well, the elephant in the room. That's the Batista family, Josley and Wesley Batista. They hold a huge controlling stake through their investment company, J&F Investimentos. And for anyone who doesn't remember, they were right at the center of Brazil's massive Operation Car Wash corruption scandal back in 2017. That whole thing led to over $2 billion in fines for JBS, and they had to set up this whole global compliance program. So it creates this fundamental tension for investors, right? You've got professional managers, but also these controlling shareholders with a really, really controversial history.
Absolutely. The tension is, well, it's obvious. And what makes it even more complex is that the Batista brothers actually rejoined the JBS board in 2023. That was after they were acquitted on some insider trading charges related to the scandal. Now, JBS has definitely made efforts to improve transparency. They created a global chief ethics and compliance officer role. They publish sustainability reports regularly. But there's still this persistent trust deficit among many investors. And it's not helped by ongoing accusations of greenwashing or links to Amazon deforestation, which are incredibly sensitive topics. In fact, things escalated just this February 2024 when the New York Attorney General actually filed a lawsuit. It directly challenges JBS's net zero by 2040 pledge, basically saying it's misleading.
Wow, that New York AG lawsuit really throws a spotlight on the ESG pressure cooker they're in, doesn't it? It kind of suggests that even with professional managers running the day-to-day, the company's past and the controlling family's shadow, well, it's long. And it can directly impact their reputation, maybe even future business.
Precisely. And that trust deficit, it translates directly into what we often call a governance discount in the stock's price. So while JBS might put up strong operational numbers like their return on invested capital, ROIC, was over 10% recently, even hit 18% back in fiscal 2022, investors are clearly demanding a higher potential return, or maybe just a lower entry price, precisely because of these historical issues and ongoing ESG worries. This really shapes that whole risky part of our undervalued but risky theme today.
Okay, shifting focus a bit within management, what about capital allocation? JBS famously grew through acquisitions, right? They bought up big names like Swift, Pilgrim's Pride.
Oh yeah, that aggressive M&A strategy was absolutely key to building their global empire. But more recently, we are seeing a bit of a pivot. They seem to be focusing more on those higher margin segments and also future-facing stuff like Vivera, the plant-based brand, and biotech foods in cultivated protein. Now, regarding shareholder returns, their dividends, they've been a bit inconsistent in the amount, but often quite large. Like the trailing yield was over 14% recently. They also have an active share buyback program going, which is interesting because sometimes that strong return of capital seems to contrast a bit with management's stated goal of structural deleveraging, paying down debt. It's clearly a balancing act for them.
That makes sense. Okay, let's really get into the numbers now. We're on to Chapter 3, Financial Analysis.
All right, first off, JBS has a market cap right now of roughly $30.45 billion, so a pretty hefty company. Looking at their 5-year revenue growth, it's actually been quite strong. They went from about $52.4 billion in 2020 up to $77.2 billion in 2024. That works out to a compound annual growth rate, CAGR, of about 10.2%, which is, pretty solid for a company this size. And the trailing 12 months ending March 2025, revenue nudged up slightly to $78.7 billion.
Okay, solid top-line growth, but what about profit margins? You mentioned earlier they can be cyclical. What do the recent numbers look like?
Yeah, that's where the cyclical nature really shows. Their trailing 12-month or TTM gross margin is currently around 15%. Operating margin is about 6.3%, and net profit margin is lower at roughly 2.5%. These numbers can swing quite a bit year to year.
Why is that? What drives that fluctuation, and what does it tell you, the listener, about the business?
Well, the cyclicality is absolutely crucial to understand. Take net income, for example. Huge swings. They made $3.1 billion profit in 2022. Then, boom, a loss of about $130 million in 2023. Then back to a $1.97 billion profit in 2024. So for you as an investor, it really hammers home the point. You cannot look at just one year's results. The entire meatpacking industry is super sensitive to commodity prices and livestock feed costs, and also big shifts in consumer demand. These external factors just bake volatility right into their bottom line.
So it's not just a JBS thing, it's kind of the nature of the industry itself. How does that volatility affect their ability to actually generate cash, free cash flow?
Yeah, free cash flow generation has pretty much mirrored that profit volatility. It hit a high point back in 2020, then dropped significantly in 2022, partly because they made some big capital investments for expansion. But then it showed a pretty decent recovery in 2023. So the takeaway is, while JBS can generate a lot of cash, it's not always steady or predictable. And that, of course, impacts things like funding future growth or paying out those dividends consistently.
Right. So thinking about financial stability then, what's the main worry, especially given that cyclicality?
The biggest financial risk, without a doubt, is their high debt-to-equity ratio. It's consistently been up there, between 250% and 275%. That signals a highly leveraged balance sheet. They rely much more on borrowed money than on shareholder equity. Now, management says they're focused on deleveraging, like they did reduce net leverage from 4.87 times EBITDA down to 4.42 times in Q4 2023, but that level of debt still needs very careful watching.
Okay, high long-term debt. But what about the short term? I saw the current ratio is around 1.62. Is that healthy? Does it help offset the debt concern a bit?
It does, yeah, to some degree. A current ratio of 1.62 is generally considered healthy. It means they have enough current assets like cash, receivables, inventory to cover their short-term liabilities, things due within a year. So while the long-term debt picture is, well, heavy, their immediate ability to pay bills seems okay. As for dividends, they do have a 13-year track record of paying something, but the actual amounts paid out have been all over the place. That makes it tough if you're relying on JBS for steady income, even though the dividend per share has grown impressively over the last 3 years, about 30%.
Okay, so we have this picture of strong revenue, volatile profits, high debt, but okay, short-term liquidity. How does the market actually value JBS compared to its competitors?
Right, this is where that undervalued aspect really jumps out from the numbers. JBS's trailing 12-month price to earnings, or PE ratio, is sitting around 8.5 times. Now compare that to peers. Tyson Foods trades around 20.5 times earnings. Hormel Foods, about 21.1 times. It's a huge difference. And that gap is largely what people call the governance discount. It's directly tied to their high debt, their exposure to potentially riskier emerging markets, and crucially, all those ESG controversies in the Batista family history we've been talking about. Investors are essentially demanding a lower price because of these non-financial risks.
And just to give you, our listener, a sense of what the business might be worth intrinsically, separate from current market mood, we use something called a discounted cash flow, or DCF model. Could you just briefly explain that concept?
Sure, a DCF model is basically a way to value a company today based on the cash it's expected to generate in the future. You project out its future free cash flows, then you discount them back to their present value, using a discount rate that reflects the riskiness of those cash flows. It's about valuing the company based on its lifetime cash generation potential. Now, based on our educational DCF model, we estimate an intrinsic value for JBS somewhere in the range of $18 to $24 per share. Key assumptions driving that: things like mid-single-digit revenue growth in the near term, maybe 2% terminal growth long term, and importantly, a higher discount rate than average, maybe 9.5% to 10.5%, specifically to account for JBS's unique risk profile.
Okay, that wraps up the core fundamentals. Now let's move into part 2 of our deep dive, looking at the broader context. Chapter 4, Market Sentiment. What's the general feeling among analysts about JBS right now?
Well, the analyst consensus is actually pretty bullish. It's rated a strong buy, which corresponds to an analyst buy rating, or ABR, of 1.00. That's the strongest possible rating. The average 12-month price target sits somewhere between $21 and $22. But, and this is important, there's a really wide range around that average. Some analysts see it going as low as $10.56, others as high as $26. That wide spread really reflects the differing views on how to weigh those risks versus the potential reward.
And how has recent news been affecting how the market sees JBS?
It's definitely been a mix. The big one, the NYSE listing, that's generally viewed as a positive. It boosts visibility, makes accessing capital easier, maybe brings in new types of investors. But that increased spotlight has also brought renewed focus from NGOs, media on the ESG issues, deforestation, carbon footprint. Those are back in the headlines. And the Batista family's controversial history, that tends to resurface too. Plus, you always have the background noise about potential U.S. tariffs on Brazilian goods, which can definitely make the market nervous in the short term.
Okay, so if the market's kind of torn, are big investors actively betting against the stock? What's the short interest look like?
Yeah, that's interesting. Short interest is actually very low. It's only about 0.81% of the free float the shares available for public trading. That suggests that, by and large, major institutional players aren't making big bets that the stock price will fall. You could read that as a sign of underlying confidence, or maybe just a lack of strong negative conviction.
And what about the technical picture? Is the stock showing upward momentum, or is it stuck?
Technically, JBS looks pretty decent right now. It's trading a bit above its 50-day moving average, which is around $13.28, and it's significantly above its 200-day moving average, currently near $10.58. So these signals generally point to positive momentum in the short to medium term and pretty strong momentum over the longer term. Suggests buyers have been stepping in recently, and the longer trend is upwards.
That gives us a good feel for the market's current temperature. Now let's look at something that deeply influences governance and risk. Chapter 5, Ownership Structure. Who actually owns JBS?
Okay, ownership. You see some big familiar institutional names on the list. Capital Group, Vanguard, DWS, the usual suspects. These are large asset managers. But the truly critical piece of JBS's ownership puzzle is the insider holding. The Batista family, acting through their investment firm JNF Investimentos, controls about 48.8% of JBS shares. That's huge. And then adding another significant layer, BNDESPAR, that's the investment arm of the Brazilian Development Bank, holds another 20.8%. So effectively, the Brazilian government is also a major, highly influential stakeholder here.
Wow. So if the Batistas and BNDESPAR together own close to 70%, that means the free float, the shares actually available for public trading, is less than 30%. That's incredibly concentrated. How does that concentration with such heavy insider and government influence affect the company and, minority shareholders like our listeners?
It really is a classic double-edged sword, isn't it? We touched on this earlier with the governance risk. On one hand, yes, that concentration creates significant governance risk. There's always the worry that decisions could favor the controlling family or maybe government interests over the interests of minority shareholders, especially with things like super voting shares for the Batistas. Smaller investors just don't have much say. But what ET, and this is the other edge of the sword, it also creates a really powerful incentive for the company's long-term success. The Batista family has an enormous amount of their wealth tied up directly in JBS, so they have a very strong vested interest in seeing the company prosper and grow over the long haul. In theory, that aligns their incentives with overall company success, which could benefit all shareholders eventually. It's just complicated.
It really is that balancing act of power versus incentive that makes it so complex to analyze. Okay, let's pull all these different threads together now. Chapter 6, Risk Assessment. Let's start by quickly recapping JBS's core strengths.
Okay, strengths. Unmatched global scale and cost leadership. That's number one. Diversification across geographies, across proteins, beef, pork, poultry, even moving into alternatives. That provides resilience. They have a strong portfolio of over 70 brands, and their vertical integration gives them good control over the supply chain and efficiency. Those are major pluses.
But the weaknesses are pretty significant too, right?
Oh, absolutely. The biggest one, that high financial leverage. Debt to equity consistently over 250%. That's a major financial risk, limits flexibility. And there's the damaged reputation from past scandals, leading to that trust deficit we talked about. The concentrated ownership and the governance risks that come with it are always there. And you just can't escape the inherent cyclicality of the business. Earnings, cash flow, they're always going to be somewhat volatile due to commodity prices and demand swings.
Okay, despite those serious weaknesses, where do you see the opportunities? Where could JBS potentially grow or improve?
Definitely opportunities exist. Expanding those higher margin, value-added products is a big one. That helps margins and reduces reliance on raw commodity prices. Their strategic move into alternative proteins that positions them well for shifting consumer trends long-term. Rising protein demand in emerging markets. JBS is perfectly placed globally to capture that growth. And importantly, there's the potential for the stock to re-rate. The NYSE listing could help, bringing more transparency, maybe attracting different investors. If they continue to genuinely improve governance, that could unlock value too.
And flipping that coin, what are the major threats? What external factors could really hurt them?
Threats are plentiful too. Volatility in livestock and feed prices is a constant pressure on costs. Animal disease outbreaks. Avian flu is a recurring example, can devastate supplier demand suddenly. There's a longer-term societal debate about meat consumption, although the pace of change is unclear. Intense ESG pressure is a big one. Deforestation links, carbon footprint, highlighted by that New York AG lawsuit. That's not going away. Geopolitical risks, like trade tariffs, are always lurking. And just general macroeconomic headwinds, inflation squeezing consumers, rising interest rates making borrowing more expensive, all these can impact JBS.
Let's focus on one specific threat for a second. Those U.S. tariffs on Brazilian imports, the 50% one supposedly starting July 2025. How does a global company like JBS, which also produces in the U.S., actually handle that?
Yeah, that's actually a great illustration of how their global diversification can work as a hedge. So yes, those tariffs would definitely hurt their Brazilian export business to the U.S., no doubt about that. But because JBS has such a massive production footprint within North America, producing and selling beef right here in the U.S., the overall hit to the company is mitigated. In fact, you could even argue those tariffs might benefit their U.S. operations. By making imported Brazilian beef much more expensive, potentially allowing JBS USA to capture more market share or even raise prices on its domestically produced beef. It's complex, but their structure gives them options.
Okay, we have covered a huge amount of ground today. Let's try and wrap this all up. Chapter 7, Conclusion.
Absolutely. This has really highlighted JBS as a company of, well, stark contrasts. It's a truly fascinating, though definitely challenging, investment case to consider.
So let's clearly lay out the bull case again for our listener. Why might someone be optimistic about JBS?
Okay, the bull case. Fundamentally, you're looking at a global leader, the biggest in its field, trading at what looks like a deep discount. That PE around 8.5x versus peers over 20x is compelling. Its massive diversification across geographies and proteins acts like a strong economic moat, giving it resilience few can match. You have clear potential catalysts for the stock to re-rate the NYSE listing, ongoing governance improvements, and strategically they're not standing still. They're pivoting towards higher margin products and investing in future growth areas like alternative proteins.
And the flip side, the bear case. What are the inescapable downsides or risks?
The bear case is equally strong, you have to say. First, that crushing debt load. Over 250% debt to equity is a constant financial vulnerability. Second, the inescapable governance and reputational risk linked to the Batista family's history. That trust deficit is real and persistent. Third, significant and growing ESG headwinds, the deforestation issue, the carbon footprint concerns, that NYAG lawsuit. These represent real operational and legal pressures. And finally, you just can't get away from the inherent, unavoidable cyclicality of the commodity meat business. Earnings and cash flow will always have ups and downs.
Okay, so let's summarize the valuation picture one last time. The current stock price for JBS is $13.80. Our educational DCF model suggests an intrinsic value range maybe between $18 and $24. Quantitatively, that certainly points towards potential undervaluation.
Right. But for you, the listener, the investment decision here isn't just about running the numbers. It's really about carefully weighing that potential quantitative reward against these profound, complex, and very persistent qualitative risks that we spent the last while detailing. So here's a final thought to leave you with. Given JBS's undeniable global scale and the potential for maybe a re-rating now that it's on the NYSE, is this the moment where its efforts on governance and strategy start to outweigh that deeply entrenched past and the inherent risks of a commodity business? Or will the market always demand some kind of Batista discount because of that history?
We really hope this deep dive into JBS NV has helped equip you with a much more complete understanding of all its complex moving parts. If you found this valuable, please do take a second to like this and subscribe to the Stock Analytics AI channel. It really helps us out.
And remember, our $4.99 a month members get priority requests for deep dives on specific tickers. Plus, big news. Over the next few months, we are planning to cover all of the S&P 500 stocks, and members will get exclusive priority access to those. If you just want a one-off deep dive on a stock you're interested in, just drop us a super thanks. We appreciate the support.
And please, always remember, this analysis was generated by an AI system. It's for educational purposes only. It should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.